Everybody, Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Friday, May 3rd, 2024. Hope you're all doing well. Sorry we missed you last week. We took a family vacation and was hoping to get the production done, but had some issues with the audio and video equipment, so I apologize for that. We'll make up for some lost time today. A lot going on this week in the markets. We had earnings. We have the Fed. Some big earnings reports, that is. We had a Fed decision and we had the jobs report. Going to cover that all with you today, and discuss some potential implications about what could be next for the market. So let's start first with the Fed. Highly anticipated, as every Fed meeting is. Was not expecting, the street was not expecting any policy changes here in the May meeting, and that's exactly what the Fed delivered, right? No changes in interest rate policy up or down, but the narrative recently had shifted to a potential concern about overheating of the economy, right? And if the economy is overheating, it would be suggestive that inflation is going to move back up. So all of a sudden, we found ourselves in a paradigm shift where instead of talking about the Fed cutting rates and how many times they'd cut, market participants and prognosticators started to suggest maybe they would have to hike rates, right, if we had a second inflationary bout. So if you look back at the 80s, right, you had two bouts of inflation. That's what a lot of people are concerned about here. So Powell all but ruled that out, said the next move is not going to be a hike. Still looking at 2 to 3 cuts for this year, right? So likely starts in June or July. July is probably the higher odds at this point. But again, as the economic data comes in, continue to evolve. Okay, so that was Wednesday. Thursday, we had a huge earnings report from Apple, right? The largest stock in the market, $3 trillion market cap. So anytime they report, you naturally want to pay attention. Apple stock hasn't had a great start to the year, so I think the market and the stock itself is pricing in a little potential slowdown in China, a little less demand for some of the new virtual reality products. But nonetheless, right, it's not the news that matters. It's the market's reaction to that news. So everybody knew that for this report, or they expected it wouldn't be a banner report for the company. But nonetheless, they delivered on some very strong numbers, showed a little overall slowdown in China, but as expected, as discussed. However, they announced the largest ever share buyback, $110 billion share buyback. So what this means, folks, is this is companies going into open markets and accumulating shares back, taking back ownership, right? And it's very supportive for stocks when you have a buyer this large of interest, right, that wants to accumulate shares, kind of puts a floor under the stock. So they won't do it all at once. It'll be done in measured steps, but we continue to see this theme across big tech of companies ramping up buyback spending. And what does that suggest? That they have a ton of cash on hand and businesses are doing pretty well. Fast forward to this morning, Friday, we got the jobs number for the month of April. So again, the situation that we find ourselves in, right? We like job growth, but when job growth is too hot, it pushes interest rates up, pushes the market down. Job growth is too cold, right? It would be suggestive of a recession. So what you want to see is job growth, but a little bit less than the trend, or a little bit less than expected. That's what we got today. Economists looking for 250,000 jobs added in the month of April. We got 175,000. So markets actually like this, even though it sounds counterintuitive. Why would you want less job growth? But it suggests that not only did the Fed have their desired impact on the economy and on the labor markets, right, with the interest rate hikes, but it's starting to show up on the surface just around the time that the Fed is talking about cutting rates. So this all aligns pretty well. So let's take a look at the market. Okay, we continue to track our projected pathway very closely, working through this rounded correction, if you will. So we've laid out some potential possibilities how markets could correct via time or via price, right? Price being steep drops, short periods, time being kind of a rounded rolling correction where you have a lot of starts and stops along the way. So we're continuing to see that type of market behavior. Markets trying to pull ourselves out of this. Now, when you see the range here, some folks had asked about buying the dip, right? What does that mean? Is that in individual stocks or is it in the broader market indexes? And it's really dependent upon the positions that we're looking to buy, right? If something is still trading at its all-time highs, we're looking for it to pull in. Other stocks have pulled back already likely completing their correction. And those are the areas that we would want to step into as we continue to see validation through the earnings reports. Something that we are watching that we did point out in the last video is our momentum oscillators, if you will, let's call it the stuff under the hood of the market, was suggestive that we were getting pretty oversold at this point. So we got to bounce out of that, and now we're trying to carve out a higher low here, which means that this low is lower than this one, right? So we're showing forward progress, taking the stairs higher. So again, markets, right? Bull market trends are known for taking the stairs up and the escalator or the elevator down. Escalator up, elevator down, right? And that's what you see. Sharp corrections, shaking people out, really shifting sentiment, if you will. So we think that markets have a little more work to do. I'm not sure if this is going to be the low, or do we potentially see, something where markets retest one more time in that range before they go. Either way, hearing from the Fed this week was a pretty supportive message for markets. So it remains to be seen how that plays out, but we'll continue to take you there every step of the way. One theme that is very prevalent in earnings is the amount of money that big tech is spending on capital expenditures, particularly AI. So you've heard me say over and over and over again, I believe we're in the new industrial revolution 2.0, where it's all going to be about tech, AI, artificial intelligence, and the efficiencies and just the mind-bending stuff that comes out of that. Companies know that. They know it's an arms race. This is a gold rush, and they're buying shovels. So we're seeing that with the spending. Obviously, these companies have a lot of money on hand to spend, so that's very healthy to see that they're reinvesting. They lowered headcounts. They did the right things to make the companies leaner. Now they're putting money into the right area. Another thing we wanted to cover, a lot of inflation over the last 2 years was driven largely through wage pressures, right? What we call the wage spiral. As companies compete for less employees, right? They're all just offering to pay more and more. It drives wages up. When you drive wages up, right, which is good for individual earners, it also drives prices, right? Because that business has higher input costs. They have to pass that on somewhere. So we're tracking wages here, and you see that it's coming back down pretty swiftly. This would be suggestive that inflation will follow this path, as wages and shelter are the two big components of that. So we'll see if we continue to see progress on that, but nonetheless, this is something that bears watching. And the thing I want to end with today is the fact that fear and greed still sits in fear category. We've been here for 3+ weeks, and all we really had, folks, right, was a mild pullback in the market. So this is the type of fear that you want to see. Markets pull back 5%, and everybody's jumping out of the pool, right? And even with the rally this week that's taken hold, and last week, right? You're working on a 2-week rally here, depending on where the market closes today. Market's obviously up big today so far, but it's not where you start, it's where you finish. We've still done nothing to pull people back into the market. So that's good. That suggests this market's going higher. It's not going to be in a straight line. I think 2024 will be characterized by great returns, but I don't think it's going to be easy. There's going to be a lot of attempts to really shake the tree, to shake people with no conviction out of this market. So we'll continue to come back every week and bring you there step by step until we get you home safely. So if you have any questions, feel free to reach out to us. Always here to talk to you about anything that matters with your money. Hope you have a great day and a great weekend. We'll see you back next week for Heritage Insider Weekly.